Welcome to our review of the Singapore dollar credit market for 2025 and a quick look ahead to the first half of 2026. The Sing dollar credit market has weathered global macroeconomic uncertainty with resilience. Year-to-date returns as of end November stand at 6.7%, outperforming 2024's full-year return of 6.5%, though slightly below 2023's 7.2%. This strong performance reinforces Singapore's reputation as a safe haven amid global volatility. In the first half of 2025, issuance activity in the Sing dollar credit market remained relatively subdued except for a noticeable surge in March. However, issuance activity rebounded strongly in the second half of 2025, bringing total issuance to Sing 32.2 billion, surpassing 2024 and marking the highest level since 2012. Financial services remained the largest issuing sector at 36%, followed by Statutory Boards at 22% and REITs at 19%, which was a sharp increase from last year. Notably, HDB led issuance with Sing 6.43 billion, including Sing 3 billion in green bonds. It wasn't only the staples and household names that contributed to 2025 performance. 2025 welcomed several new issuers, including Equinix, Prudential, and Netlink, NBN Trust, alongside returnees to the Sing dollar credit market like Optus Finance, the financing vehicle for Singtel Optus, and ICBC. We also saw strong participation from Middle Eastern issuers, with volumes rising to around Sing 2.9 billion, underscoring Singapore's growing appeal as a global funding hub. Market dynamics also played a part. Despite geopolitical tensions and tariff uncertainties earlier in the year, credit spreads tightened significantly after a brief spike in April. Benchmark rates also declined, with the 3-month compounded SORA falling from around 3% at the start of the year to 1.25% by end November, creating a favorable borrowing environment. Green, social, and sustainability-linked bonds gained traction, accounting for 25% of total issuance, led by HDB and major REITs. Duration extension was another key trend, with mid to long tenor bonds making up 45% of issuance as issuers locked in lower rates and reduced refinancing risk. Looking ahead, we expect issuance volumes to moderate after this year's bumper activity that was driven largely by refinancing and capital replacement. However, a stable rate environment and continued demand for high-grade credit should support healthy issuance levels. Global participation and sustainability-linked financing are likely to remain strong themes. So how do we position heading into 2026? Our 5 key takeaways to highlight include: number 1, a higher probability for Sing dollar credit spreads to widen modestly from current levels that are relatively tight by historical standards. This follows strong performance in 2025 and will be against a backdrop of a still growing economy and expectations of stable credit fundamentals among Sing dollar credit issuers. Number 2, we expect total positive returns for 2026, however mainly from coupons and distributions rather than capital gains. With few drivers for capital appreciation and defaults to remain subdued, we focus on earning returns through credit exposure. Number 3, as such, we are selectively overweight non-financial corporate perpetuals with higher yields. We expect the majority of perpetuals with first call dates in 2026 to be called, as they can most likely be replaced at lower cost to issuers compared to distribution rates after reset, should the issuer opt not to call. Even if not called, investors should be comfortable with the risk that these securities could remain outstanding till perpetuity. Number 4, we also remain selectively overweight bank capital instruments, particularly those with high yields and wide reset spreads. We also continue to like Tier 2 insurance papers. Within bank capital instruments, we prefer additional Tier 1s or AT1s over Tier 2s, given the recent spread widening, with spreads expanding more for AT1s year-to-date 2025 versus those for Tier 2s. We also consider expectations of a soft landing scenario in 2026, resilient fundamentals of banks, as well as the ongoing search for yield in the Sing dollar credit market. As for insurers' Tier 2s, these continue to provide decent yields, while the issuers in the Sing dollar space have strong credit profiles. Finally, number 5, we are neutral Sing dollar bullet bonds with a slight preference for higher yielding bullets in the belly and longer tenors, which generally consist of corporate bonds with higher coupon rates. These higher yields can help offset potential capital loss in a downside scenario which assumes a modest increase in rates. Meanwhile, shorter tenors, particularly investment grade, look less compelling at current tight levels. In summary, 2025 showcased the resilience and depth of the Sing credit market, reinforcing its role as a safe haven and a preferred destination for global issuers. As we move into 2026, the market is well positioned to navigate uncertainties while sustaining its growth momentum.